Hey folks, welcome to a product review at Finominal. Today we're going to look at funds that provide access to quantitative investment strategies, which is also known as QIS. And another name for that would be risk premia strategies. Now, these kind of like products or funds aim to provide uncorrelated returns by combining multiple risk premia strategies across asset classes. So from equities, fixed income, commodities, and securities. And you can think of this like doing a value strategy, not only in equities, but also across other asset classes and combining that with quality strategies and so on. Now, this is an area that has grown to around 700 billion of assets under management. So let's explore in terms of how these funds have done and what explains their success in AUM growth. Now, the products we're going to look at are products from AQR, Franklin, Wellspring, Simplify, and Fidelity. Two of these are ETFs, three of those are mutual funds. And the first thing that we're going to investigate is if these products do what they're supposed to do in the sense of providing uncorrelated returns. And indeed, we see that all 5 products are close to zero on the correlation to stocks or correlation to bonds. So from that perspective, they should be interesting as diversifying strategies. So the kind of 2 criteria for diversifying strategy, broadly speaking, is one, is it uncorrelated returns? And then secondly, is it positive returns? And we're going to check the second one. But before we do that, let's have a quick look at the factor exposures. So here we do indeed see that the beta to the stock market, as represented by the S&P 500, was close to zero. It's good. We do see slight betas to bonds, no exposure to commodities, and positive betas to the US dollar index. Having said that, what's more interesting is the 2 products, namely one from AQR, QSPIX, and the one from Franklin, FLSP, have positive betas to value and momentum. And that simply means that if you add those strategies to your portfolio and you already have exposure to value or momentum products, you're partially duplicating risks. So that's something to be aware of. Now, let's move on to the second characteristic of what makes kind of like risk premia or diversifying strategies in general attractive, which is positive returns after being uncorrelated. So from a performance perspective, we only do have 1.6 years of data, which is not really meaningful to be fair, because most of those products just were launched recently. Having said that, if you look at the performance since, January 2024, we can see that 3 products generate positive return and one of them barely, right, which is a product from Wellspring. And in terms of Sharpe ratios, actually 3 of them produce negative Sharpe ratios, simply because the risk-free rate is moderately high at the moment. So that's not great in terms of looking at those 5 products in the sense of like 3 of them not being attractive. So we're going to introduce a bit of survivorship bias by focusing on the better performing products. And this is the AQR Star Premia Alternative Fund and the product from Franklin, which is FLSP. So here we have a bit more data. We can go back to 2019. Having said that, this is when FLSP was launched. But unfortunately, we do see that over the entire track record of LSP, this product basically generated a almost 0% return. And as mentioned, the Sharpe ratio would be negative, right, if you deduct the risk-free rate. In contrast, the product from AQR has done well, right? And remember, these are uncorrelated returns, right? So now we have uncorrelated and positive returns, which makes this highly attractive. Now, the one thing that is worth flagging about QSPIX is that we can compare that to another product of AQR, which is AQR's equity market neutral fund. And if we do this, we effectively see that over or more than a 10-year track record, these products are almost identical. And this is not intuitive because the style Premia fund is supposed to provide exposure to, well, risk premium strategy across asset classes versus equity market neutral, right? This is only exposure to value, momentum, and quality via equities. But given that the performance of these is almost identical, that either means, right, that the risk premium strategy of other asset classes, i.e. fixed income, commodities, and currencies, have just netted themselves off, or what would be kind of like the worst situation, are just not positive in reality, right? Because in contrast to academic research, right, these are realized returns. So that's with regards to QSPIX, right? So it is an interesting fund, but you should, and QMX is also an interesting fund. Both provide uncorrelated returns. Both have been positive, right? So these have been great diversifiers, but you should not allocate to both funds, right? You should pick one. And so this kind of concludes our analysis of QIS strategies with Premia funds, right? These are both the same terms for the same thing. And unfortunately, despite the growth in this area, right, as mentioned, there's around 700 billion of assets by now. At least by looking at these 5 public funds via proxies, we've seen that, well, 4 out of 5 have disappointed, right, in terms of having negative Sharpe ratios. So there's only one product that has done well. Hope that helps. Have a nice day.